Valuation Metrics. Welcome to Module 3. In this crucial section, you will learn about financial tools specifically designed to determine the value of assets, companies, or projects. By the end of this module, you'll be able to apply valuation metrics like net present value and internal rate of return to make sound investment decisions, compare different opportunities effectively, and understand the economic profitability of your real estate ventures. So, what are valuation metrics? These are financial tools that help us figure out what an asset, a company, or a project is actually worth. They provide insights into the economic value of an investment and are key to making informed decisions. Why are they so important? Think about it. Before you invest, you want to know if something is truly worth the money and the risk you're taking, right? Valuation metrics help us do just that. They allow us to make informed investment decisions. They help us decide if a particular investment makes sense based on its expected future cash flows and an appropriate discount rate, which accounts for risk and the time value of money. Compare alternatives. These metrics let us compare different investments, even if they have different timelines, risk levels, or involve different amounts of money. Measure economic profitability. They go beyond just looking at how much money comes in. They consider when that money comes in, how certain it is, and what its value is in today's terms. Price assets, companies, or projects. These tools are used to estimate the market value of assets or projects, even if there isn't a readily available market price. For instance, what's a unique property really worth? Manage risk. Valuation metrics inherently reflect the risk involved in an investment and allow us to price that risk correctly within our analysis. In this chapter, we're going to discuss several key valuation metrics: discount rate, net present value (NPV), discounted cash flow (DCF), reversion cap rate, often used within DCF, and the internal rate of return (IRR). Let's begin with a fundamental concept that underpins many valuation techniques: the discount rate. Discount rate. Imagine someone offers you $100 today or $100 a year from now. Which would you choose? Most likely, you'd take the $100 today, right? That's because money available now is worth more than the same amount in the future. This core idea is central to understanding the discount rate. What is the discount rate? The discount rate is the minimum rate of return an investor expects to receive on an investment, considering its risk. In simple terms, the discount rate represents two key things: the time value of money. A dollar today is worth more than a dollar tomorrow because today's dollar can be invested to earn a return, and the risk associated with the investment. The riskier the investment, the higher the return you demand. It's important to remember that the discount rate is often from the investor's perspective. It's not necessarily what an asset is objectively worth, but rather what it's worth to you, based on your return expectations and the level of risk you're willing to take for that specific investment compared to your other options. Why is the discount rate important? It's used to calculate the net present value, NPV, of future cash flows, which is a cornerstone of investment analysis. We'll talk more about NPV soon. It directly reflects the level of risk in an investment. It helps investors make informed decisions about whether an investment's expected future returns are attractive enough today. What's the implication? The basic rule is riskier investments require a higher discount rate. Why? To compensate the investor for taking on that extra risk. If you're taking a big risk, you want the chance of a bigger reward. The risk itself can be affected by many factors, such as the stability of the business or project. For example, a well-established property with long-term tenants versus a speculative development. Current market conditions, for example, a booming economy versus a recession. The overall economic situation, for example, inflation, interest rate environment. Factors affecting the discount rate. Risk-free interest rate. This is the theoretical rate of return you could get on an investment that has zero risk. In practice, people often use the yield on government bonds, like US Treasury bonds, as a proxy for the risk free rate. It serves as the base level for calculating the discount rate. If you can get, say, 3% on a government bond with virtually no risk, any other investment must offer more than that to be attractive. Risk premium. This is the additional return investors demand for taking on risk above and beyond the risk free rate. The riskier the investment, the higher the risk premium. This premium varies greatly depending on the specific investment's risk level, type of property, location, tenant quality, market conditions. Cost of capital. This represents the minimum return that investors, both equity holders and debt providers, require to invest in a company or project. It includes the cost of all sources of financing, equity. This is the cost of raising capital by issuing shares, or more simply, the return that shareholders expect for investing their money. Debt. This is the cost of raising capital through loans or bonds, which primarily includes the interest payments and any other associated fees. When can discount rate be compared to cap rate? We talked about cap rate earlier. How does it relate to the discount rate? In very simple, stable cases, cap rate might approximate the discount rate. We could say that the cap rate is roughly equal to the discount rate when future cash flow is expected to be the same as current cash flow indefinitely, and there's no unusually high risk or complexity. This might apply if cash flow is constant and stable over time, no growth or decline expected. No significant changes are anticipated, like major renovations or changes in market conditions. There are no unusual future expenses or a dramatic future sale value to consider separately. In most real world cases, cap rate is not equal to the discount rate. The discount rate is usually a more comprehensive measure that reflects more than just the first year's NOI divided by current price. Many factors influence the discount rate that aren't captured directly by a simple cap rate. Considerations of a specific investor. Each investor has different return requirements and alternative investment opportunities. Your discount rate is personal to your expectations. Future sale return, capital gains. The discount rate, when used in a discounted cash flow analysis, which we'll cover, considers all future cash flows, including the net proceeds from a future sale of the property. This expected appreciation is a component of the total return, which the discount rate reflects. A simple cap rate only looks at current income relative to current value. Different risk levels. The discount rate explicitly accounts for the specific risk profile of the property, its location, tenant strength, lease terms, property condition, etc. Changes in cash flow. The discount rate is used to value a stream of cash flows that are expected to change over time. For example, rents increasing, vacancy periods, major renovation costs, and then a final sale. Cap rate is a snapshot. Example of cap rate versus discount rate. An asset has a current net operating income of $100,000 and is valued at $1,250,000. This gives a cap rate of $100,000 divided by $1,250,000 equals 8%. However, the investor expects rents to grow over time, but also perceives the investment as having a certain level of risk. They also plan to sell the property in 5 years, hoping for a profit on the sale. Because of these factors, growth potential, risk, future sale, the investor might require an overall return of, say, 11% from this investment. This 11% would be their discount rate used to value those future expected cash flows, including the sale. In this case, the discount rate, 11%, is higher than the cap rate, 8%. Bottom line, the cap rate is often seen as a static, simpler metric. The discount rate is a more dynamic measure used to evaluate a series of future cash flows over time, incorporating growth, risk, and the time value of money, including a future sale. The discount rate will usually be higher than the going-in cap rate if future income growth or a profitable resale is expected, as it reflects the total required return from all sources of cash flow over the holding period. How do we calculate or determine the discount rate? Determining the appropriate discount rate is a critical and often complex part of investment analysis. It's not just a formula, it involves judgment. It represents the required return on an investment, considering its risk. There's no single formula that fits all situations perfectly. Here are common approaches. Required return approach. This is often the most practical approach for individual real estate investors. You ask, what minimum total return do I want or need from this investment, given its specific risks and my other alternatives? Examples. For a residential property in a less stable peripheral area with potentially unreliable tenants, an investor might demand a higher return, say 10 to 12% or more, to compensate for the higher risk. This would be their discount rate. For a prime commercial property in a major city like Tel Aviv, leased to a very strong long-term tenant, the risk is lower, so an investor might accept a lower return, perhaps 7 to 8%. Market comparison approach. This involves looking at what similar transactions are happening at in the market. Example. If real estate company reports or market data show that similar properties in the area are trading at a 7% capitalization rate, you might assume that the required returns and thus discount rates for such properties are in that general range or perhaps slightly above it to account for the total return expectation, including future growth at sale, which a simple cap rate doesn't fully capture. CAPM model, capital asset pricing model. This is a more academic approach, less commonly used directly by individual private real estate investors due to data challenges, but the principles are relevant. The data required to calculate a discount rate using CAPM would be risk-free rate, for example, government bond yield, a measure of the investment sensitivity to overall market movements. This is often difficult to measure accurately for private real estate assets, but can sometimes be estimated based on publicly traded real estate companies. Overall market return, the expected return of the broader market, for example, a stock market index or a relevant real estate market index. Choosing the right discount rate is crucial because it significantly impacts the outcome of valuation calculations like net present value. Next, let's discuss a specific type of cap rate used when forecasting the future sale of a property, the reversion cap rate. Reversion cap rate, also known as exit cap rate or terminal cap rate. When we invest in a property, we often don't plan to hold it forever. We anticipate selling it at some point in the future. How do we estimate what that property might be worth when we decide to sell it, say, 5 or 10 years down the line? This is where the reversion cap rate comes in. What is reversion cap rate? The reversion cap rate or exit cap rate is a financial metric used to estimate the future sale price, also known as the reversion value or terminal value, of a real estate asset at the end of an investor's projected holding period. It assumes the asset will be sold on the market at that future date. In simple terms, the reversion cap rate is the capitalization rate that is assumed or projected to be appropriate for valuing the property at the end of the holding period, based on its expected net operating income in the year of sale. The investor's goal is often to sell the asset in the future at a good price, hopefully higher than what they paid, after it has generated income for them. In the discounted cash flow method of valuation, which we'll get to shortly, this estimated future sale price is a very important component called the terminal value. It's the estimated value of the asset at the end of the explicit forecast period. So, the formula to calculate the future sale price using a reversion cap rate is future sale price, terminal value, equals future NOI divided by reversion cap rate. It's important to note that in most valuation models, the reversion cap rate is an assumed input that the analyst chooses, not usually a calculated result from other data within the model itself. It's a forecast. How does it work? First, you estimate the expected net operating income of the asset for the year it's projected to be sold. Then, you determine or assume an appropriate reversion cap rate that you believe will be representative of market conditions and the property's characteristics at that future sale date. Finally, you divide the projected future NOI by this chosen reversion cap rate to arrive at an estimated future sale price, terminal value of the asset. Significance of reversion cap rate for an investor. What does a smart investor want when thinking about the reversion cap rate for their future sale? A high future NOI. They want the property to be generating a lot of net operating income by the time they plan to sell it. A low reversion cap rate. When it comes time to sell, they hope the market will highly value assets like theirs. A lower reversion cap rate applied by future buyers means those buyers are willing to pay a higher price for each dollar of NOI the property generates. So, a lower assumed reversion cap rate at the time of sale leads to a higher estimated selling price for the current investor. What makes a reversion cap rate go up or down? Many factors come into play when estimating what this rate might be in the future. Demand versus supply. If demand is higher than supply in the future market, that market is considered stable or strong. Income-generating assets will likely be more in demand, and perceived risk might decrease. This would lead to the reversion cap rate decreasing, which in turn means the future value of the asset would increase. Risk level in the market, lower perceived risk in the future, for example, due to strong tenants, a stable economic environment, would cause the reversion cap rate to decrease. Asset location, a prime location that remains strong, in demand, and offers good accessibility and services would likely lead to a lower reversion cap rate. Condition of the asset. An asset that is well renovated and maintained at the time of future sale will likely attract good tenants and require less immediate future investment from a new buyer. This tends to decrease the reversion cap rate. Interest rate in the market. If interest rates in the market are expected to be lower in the future, real estate investments might become relatively more attractive, potentially leading to a decrease in the reversion cap rate. Future development plans in the area. If no new competing development is on the horizon at the time of sale, this could mean stable demand with limited supply, potentially leading to a decrease in the reversion cap rate. Economic growth in the area. A positive economic growth forecast for the area at the time of sale. For example, job growth, improved transportation, new academic institutions. Suggests stability and potential for value increase, which could decrease the reversion cap rate. Rental expectations. If there's an expectation of an increase in market rents around the time of sale, this means higher future income potential for the next buyer. This can contribute to a higher future value and may be reflected in a lower reversion cap rate being applied to an already higher NOI. Example of reversion cap calculation to find future property value. Let's say we have the following projections for the time we plan to sell a property. Future NOI expected in the year of sale, $500,000. Assumed reversion cap rate at time of sale, 10%. Now, let's calculate the estimated future property value. Future property value equals future NOI divided by reversion cap rate. Future property value equals $500,000 divided by 0.10, which is 10%. Future property value equals $5 million. So the estimated future sale price of the property is $5 million. The reversion cap rate used here, 10%, means that the property's future sale value is estimated based on a potential buyer at that time expecting a 10% return on their purchase price from the projected NOI in that final year. The difference between cap rate and reversion cap rate. It's important not to confuse the initial cap rate when you buy or value a property today with the reversion cap rate, which you estimate for a future sale. Here's a comparison. Cap rate refers to the current income of the asset, used to assess the current value of the asset, based on current and known or reasonably estimated for the immediate future data. Examines the unleveraged return you are receiving today on the investment if you buy at the current market price. Helps determine if it's worth buying the asset right now. It's used for purchase analysis. When buying, an investor often looks for a higher going in cap rate, as it might suggest they are buying the asset relatively cheaply compared to its current income, indicating a potentially more profitable transaction from day one. Reversion cap rate, exit cap rate, refers to the expected future income of the asset, NOI, in the year of sale, used to assess the future sale value of the asset. Based on future estimates and forecasts about market conditions and property performance years from now. Examines the return that a future buyer will likely expect to receive when they buy it from you. Helps determine how much you might receive when you sell the asset in the future. It's used for future sale analysis as part of a discounted cash flow valuation. When forecasting their sale, an investor generally hopes for a lower reversion cap rate to be applicable at the time of sale. A lower exit cap rate applied to their future NOI means the market, i.e., the next buyer, will be willing to pay a higher price for that income stream, resulting in a higher sale price for the current investor. Now that we understand discount rates and how we might estimate a future sale price, let's look at a core valuation method that brings these concepts together: net present value. Net present value, NPV. If an investment is going to give you various amounts of cash at different times in the future, how do you figure out what all that future cash is worth to you today? And how do you compare that to what the investment costs you today? This is precisely what net present value, or NPV, helps you do. What is net present value, NPV? NPV is a financial metric used to evaluate the present value of a series of future cash flows, both positive cash flows, like revenues or rental income, and negative cash flows, like expenses or further investments, compared to the initial investment cost. In simple terms, NPV shows us how much a future stream of money is worth in today's dollars after accounting for the initial cost. Why is NPV important? NPV directly incorporates the time value of money. As we've discussed, money you have today is worth more than the same amount you might receive in the future, because today's money can be invested and earn a return. NPV uses a discount rate to bring all future cash flows back to their present value. It helps investors decide whether a particular investment is economically viable. It allows for a clear comparison between different investment opportunities, even if they have different cash flow patterns or timing. The rule of thumb for NPV. The NPV calculation essentially finds the difference between the present value of all the expected future cash inflows from an investment and the present value of all the cash outflows, including the initial investment, which is an outflow at time zero. Therefore, if NPV is positive, the investment is generally considered viable. It means the present value of the expected future cash inflows is greater than the present value of the outflows. The investment is expected to generate more value in today's terms than it costs. If NPV is negative, the investment is generally considered not viable. The present value of the expected future cash inflows is less than the present value of the outflows. It's expected to generate less value in today's terms than it costs. If NPV is zero, the investment is on the borderline, neither particularly profitable nor a loss in present value terms. It means the investment is expected to earn a return exactly equal to the discount rate used in the calculation. NPV is calculated using a method called discounted cash flow, DCF, which we'll explore next. Discounted cash flow, DCF. So, how do we actually calculate those present values that make up the NPV? The most common method is called discounted cash flow or DCF analysis. DCF is a valuation method based on forecasting the future cash flows that an asset, like a company, a project, or a piece of real estate, is expected to generate, and then discounting all those future cash flows back to their present value using a discount rate. In simple terms, DCF tries to determine how much an asset is worth today based on all the money it is expected to make or cost in the future. Why is DCF considered reliable? DCF is often considered a reliable and fundamental valuation method because it's based on actual expected future cash flows rather than on accounting metrics like net profit, which can sometimes be influenced by non-cash items or accounting choices. Cash flow is often seen as king in valuation. DCF helps investors evaluate the viability of investing in a particular asset. Companies also use it internally to make decisions about new project investments, acquisitions, and mergers. In a typical DCF analysis for an income-generating real estate asset, cash flows are usually considered in two main periods. First, the detailed forecast period. This is a specific number of years for which the analyst forecasts detailed annual cash flows, like rental income, operating expenses, capital expenditures. Second, the period after the detailed forecast. What about the value of the asset beyond this detailed forecast period? For assets that have a long life, like real estate, a significant portion of their value often comes from the cash flows they are expected to generate after the initial forecast horizon. This is captured by the terminal value. The terminal value represents the estimated present value of all the cash flows the asset is expected to generate after the detailed forecast period ends, extending out indefinitely, or until the end of its economic life. This terminal value is a crucial component because it captures the long-term value of the asset, and it often makes up a very significant portion of the total estimated asset value, especially for properties with a long income-generating life. As we discussed, the terminal value is often calculated using an assumed reversion cap rate applied to the NOI at the end of the forecast period. And, as mentioned, DCF is the methodology used to calculate the net present value, NPV. Advantages and disadvantages of DCF. Like any valuation method, DCF has its strengths and weaknesses. Advantages of DCF considers the time value of money. This is a core strength. Forward-looking and comprehensive. DCF is inherently forward-looking, allowing investors to model all expected cash inflows over the entire holding period, from ongoing rental income to the final sale proceeds. Accounts for capital gains or losses. Unlike simple income-based metrics, like a basic cap rate that just looks at 1 year's income, DCF incorporates the expected profit or loss from the eventual sale of the property via the terminal value. Allows comparison of different investments. It can be used to compare different investment opportunities even if they differ in their lifespan, investment amount, or the pattern of their cash flows. Can reflect risk through the discount rate. The investor can and should choose a higher discount rate for riskier assets, which will result in a lower present value, appropriately reflecting that risk. Disadvantages of DCF, highly sensitive to assumptions. This is probably its biggest challenge. A small change in key assumptions, such as the discount rate chosen, the projected growth rate of rents, the assumed vacancy rates, or the reversion cap rate for the terminal value, can dramatically impact the resulting valuation. Garbage in, garbage out definitely applies. Requires accurate forecasts. The method relies on an analyst's ability to make reasonable forecasts of future cash flows. This is not always easy to do precisely, especially for long periods into the future. The further out you forecast, the less certain those forecasts become. Technically complex, it can require a good understanding of financial concepts and usually involves building a spreadsheet model or using specialized software. It may not be suitable for absolute beginners without some guidance. The result is not always tangible. Unlike a simple yield percentage, like cap rate or COC, DCF typically produces a present value in dollar terms, the NPV. This absolute dollar value is not always immediately intuitive to everyone. Ignores unexpected events, black swans. While you can do sensitivity analysis, the base DCF model usually assumes a certain path of future events. It doesn't easily account for completely unexpected major events like sudden changes in interest rates, new regulations, a pandemic, or dramatic unforeseen property specific adjustments unless you build scenarios for them. DCF is a powerful tool for gaining deeper insights into an investment's value, but its full and proper implementation can be challenging. Many private investors often combine it with simpler, more market based methods like comparing recent sales prices or using GRM or cap rates for initial screening as a reality check. How do you actually perform a DCF valuation? Here are the key steps involved. First, you need to forecast the free cash flows, FCF, that the asset is expected to generate during your chosen detailed forecast period, for example, for the next 5 or 10 years. In real estate, free cash flow often refers to net operating income minus capital expenditures, major improvements or replacements for each year. Next, you need to determine the appropriate discount rate. This rate should reflect the risk associated with the investment in the asset and your required rate of return, as we discussed earlier. Discount cash flows to present value. Each projected future cash flow for each year in your forecast period is then discounted back to its present value using the chosen discount rate. Calculate terminal value, TV. Then, you need to estimate the value of the asset after your detailed forecast period ends. This is the terminal value. As mentioned, this represents the present value at the end of the forecast period of all the expected future cash flows from the asset beyond that forecast horizon. A common method to calculate this in real estate is using the reversion cap rate method. You project the NOI for the year after your forecast period ends. For example, year 11 NOI if your forecast is 10 years, and then you divide that by your chosen reversion cap rate. This gives you the estimated sale price, terminal value, at the end of year 10. Discount terminal value to PV. This terminal value, which is a value at the end of your forecast period, must also be discounted back to its present value today using the same discount rate. Calculate net present value, NPV. Finally, you sum up the present values of all the projected cash flows from the detailed forecast period and the present value of the terminal value. From this sum, you subtract the initial investment cost. The result is the net present value. The net present value is calculated using the following general formula. NPV equals minus cash flow at time 0 plus cash flow at time 1 divided by 1 plus r raised to the power of 1 plus cash flow at time 2 divided by 1 plus r raised to the power of 2 plus cash flow at time n divided by 1 plus r raised to the power of n plus TV divided by 1 plus r raised to the power of n, where CF0, this is the initial investment cost. It's a negative cash flow because it's money going out at the start, time 0. CFT, this is the cash flow, positive or negative, expected in each period, T. For example, year 1, year 2, up to year N, the end of the forecast period. R. This is the discount rate, your required rate of return or interest rate used for discounting. N. This is the number of periods in your detailed forecast. TV, terminal value. This is the estimated value of the asset at the end of the forecast period. N. For example, the expected sale price. This TV itself is then discounted back from period N to period 0. This formula essentially reflects the present value of all expected future cash inflows, plus the present value of the future sale, terminal value, all minus the initial cost of the investment. Example of NPV calculation. Let's walk through a simplified example. Data. Initial investment at year 0, $10,000. This is an outflow. Cash flow at the end of year 1, $5,500. Inflow. Cash flow at the end of year 2, $5,700. Inflow. Terminal value, TV, at the end of year 2. Expected sale proceeds on top of cash flow at the end of year 2. $2,000. Inflow. Discount rate, R, 15%. Calculation, NPV equals negative $10,000 plus $5,500 divided by 1 plus 0.15 to the power of 1 plus $5,700 divided by 1 plus 0.15 squared plus $2,000 divided by 1 plus 0.15 squared. NPV equals negative $10,000 plus $4,782 plus $4,310 plus $1,512. NPV equals $604. So, the net present value, NPV, of these future cash flows, including the terminal value when discounted at a rate of 15%, is $604. The NPV is positive, but it's relatively small. This investment is barely worthwhile. It's expected to generate a return just slightly above the required 15% discount rate. A small negative change in the expected cash flows or a small increase in the discount rate could easily turn the NPV negative. If the NPV were negative, the investment would be considered unviable, not expected to meet the 15% required return. Given this sensitivity, it would be very important to perform a sensitivity analysis to assess the risks of this investment. How does the NPV change if cash flows are lower or if the discount rate is higher? We've mentioned terminal value, TV, a few times. Let's just be very clear on how it's calculated and then brought back to present value within a DCF. Steps to calculate the future terminal value. First step, you estimate the net operating income that the property is expected to generate in the year immediately following the end of your detailed forecast period. So, if your forecast period is N years, you'd estimate NOI for year N plus 1. Second step, you need to carefully select an appropriate reversion cap rate. This rate should be based on what you expect market conditions and the characteristics of similar assets to be like at the end of your forecast period when you plan to sell the property in your model. The reversion cap rate is usually different from the going-in cap rate, the cap rate at the time of purchase or current valuation. It might also be different from the discount rate used for the annual cash flows. Why? Because it reflects market conditions and risk perceptions specifically at that future point of sale, which may differ from today's conditions or your overall required return for the holding period. Often, analysts choose a reversion cap rate that is slightly higher than current market cap rates for similar properties to be conservative, or if they expect interest rates to be higher or risk perception to increase in the future. A higher reversion cap rate indicates a more conservative approach to the exit value, meaning a lower estimated sale price for a given NOI. Third step, you divide the projected future NOI for year N plus 1 by your chosen reversion cap rate. This gives you the terminal value, TV, of the asset, which is its estimated sale price at the end of year N. The formula terminal value at end of year N equals NOI in year N plus 1 divided by reversion cap rate. Last step, discounting the terminal value to its present value today, year 0. Once you have this future terminal value, you must then discount it all the way back to its present value today, year 0. You do this using the same discount rate that you used to discount the annual cash flows during the detailed forecast period. Example of calculating and discounting terminal value in the DCF model. Let's use some assumptions. Detailed forecast period, 2 years. Expected net operating income in year 3, the year after the forecast period ends, $20,000. Assumed reversion capitalization rate at the end of year 2, 10%. Discount rate for the 2-year holding period, 5%. Calculation steps: calculate the future terminal value, TV, at the end of year 2. Future terminal value equals net operating income in year 3 divided by reversion cap rate equals $20,000 divided by 0.10 equals $200,000. This $200,000 is the estimated sale price of the asset at the end of year 2. Calculate the present value of this terminal value, PV of TV, as of today, year 0. The end of the forecast period is year 2, so N equals 2. PV of TV equals future TV divided by 1 plus discount rate raised to the power of N. PV of TV equals $200,000 divided by 1 plus 0.05 raised to the power of 2 equals $181,406. Result: the present value of the terminal value is $181,406. This amount represents the value today of all the future expected cash flows from the asset after the detailed forecast period of 2 years, as perceived today, considering a 5% discount rate. This $181,406 would then be added to the present values of the cash flows from year 1 and year 2 to get the total estimated value of the property using the DCF method. Now, let's look at another very important valuation metric that is closely related to NPV, the internal rate of return. Internal rate of return, IRR. We've seen how NPV tells us if an investment is worthwhile in today's dollars, given a specific required rate of return, the discount rate. But what if we want to know what the investment's own inherent rate of return is over its entire life, considering all its cash inflows and outflows and the timing of that cash? That's what the internal rate of return, or IRR, tells us. What is internal rate of return, IRR? IRR is a financial metric that represents the average annual rate of return that an investor is expected to receive from an investment over its entire life, assuming that all the cash flows generated by the investment are reinvested at that same IRR rate. In simpler terms, IRR shows the true effective compounded rate of return of an investment, taking into account the time value of money. How does IRR work? Mathematically, the IRR is the specific discount rate at which the net present value of all the investment's cash flows, both positive and negative, equals exactly 0. In other words, it's the discount rate that makes the present value of all expected future cash inflows equal to the present value of all cash outflows, including the initial investment. So, IRR is the rate at which NPV equals 0. Main uses of IRR: evaluating the viability of investments. Is the project's expected return attractive? Making informed investment decisions. Often, an investment is considered acceptable if its IRR is greater than the investor's required rate of return, also known as the hurdle rate or the discount rate they might use for NPV. Comparing the returns of different investments over time, especially those with different cash flow patterns. Why is IRR important? The IRR metric is often considered one of the most accurate measures of the overall percentage return of an investment, for two main reasons. It accounts for the timing of cash flows, time value of money. IRR inherently understands that when money actually comes in and goes out matters. As we know, $10,000 received today is worth more than $10,000 received in 2 years, and IRR reflects this. It factors in the effect of compounding interest, implicitly. IRR is based on a calculation where accrued profits are effectively assumed to be reinvested at the same IRR rate. This leads to a result that simulates the effect of compounding interest over the life of the investment. Factors affecting IRR. What can make an IRR higher or lower? Cash flows. The higher the positive cash flows and the lower the negative cash flows, the higher the IRR will generally be. Larger net positive cash flows increase the overall return. Timing of cash flows. Earlier cash flows have a greater positive impact on IRR than later cash flows. This is because of the time value of money. The sooner you receive cash, the more valuable it is, and the more opportunity there is for it to be reinvested and earn further returns. Initial investment. The lower the initial investment amount for a given stream of future positive cash flows, the higher the IRR will be. A lower initial outlay means less money is required to generate those same future cash flows, thus boosting the percentage return. Advantages and disadvantages of IRR. Like NPV and DCF, IRR is a powerful tool, but it's not without its limitations. Advantages of IRR. IRR provides a single rate of return that is relatively easy to compare to an investor's required rate of return, their hurdle rate, or to the IRR of other projects. Consideration of the time value of money. This is a key strength. IRR correctly accounts for the fact that money today is worth more than money in the future. Consideration of all cash flows. IRR takes into account all the expected cash flows from the investment over its entire projected life, from the initial investment to the final cash flow, which might include sale proceeds. Useful for comparing and ranking projects, IRR can be used to rank different investment opportunities based on their expected percentage return potential. Disadvantages of IRR. Implicit assumption about reinvestment rate. This is a critical one. IRR implicitly assumes that any interim positive cash flows generated by the project can be reinvested at the IRR rate itself. For example, if a project has an IRR of 20%, the calculation assumes you can take cash received in year one and reinvest it somewhere else to also earn 20% until the end of the project. This may not always be realistic, especially if the IRR is very high. If the actual reinvestment rate available is lower, the true overall return might be less than the calculated IRR. Issues with non-conventional cash flows. For projects with non-conventional cash flows, meaning the sign of the net cash flow changes more than once, for example, initial negative investment, then some positive flows, then another significant negative flow, perhaps for a major repair, then more positive flows. There might be multiple IRR solutions, or even no real IRR solution at all. This can make the IRR result ambiguous or unusable in such cases. Conventional cash flows usually have one initial negative outflow, followed by a series of positive inflows. Does not consider the size, scale of the investment directly. IRR focuses only on the percentage rate of return and not on the absolute dollar value of profit created. A very small project might have a very high IRR. For example, invest $10, get back $15 next year, high IRR, but it might create much less absolute wealth than a much larger project with a slightly lower IRR. For example, invest $1 million, get back $1.2 million next year, lower IRR but much bigger dollar profit. Sometimes NPV can give a better picture of total value creation. Sensitivity to cash flow projections. Just like DCF and NPV, IRR is highly dependent on the accuracy of your future cash flow projections. If those forecasts are flawed, the resulting IRR can be very misleading. Limited insight into risk on its own. IRR itself doesn't inherently tell you about the risk associated with achieving that return. A project with a very high IRR could also be extremely risky. The IRR formula. The IRR is the discount rate R or IRR such that 0 equals the sum of CFT divided by 1 plus IRR raised to the power of T for all periods T from 1 to N minus the initial investment CF0, where CFT cash flow in period T. CF0 initial investment, usually a negative cash flow at time 0. IRR, the internal rate of return. This is the rate you are solving for. Sigma represents the sum of T, the number of time periods, N, the total number of periods. Explanation of the formula. The formula is essentially setting the NPV equation to zero and solving for the discount rate, IRR, that makes this true. It's saying find the rate, IRR, at which the present value of all future positive cash flows exactly equals the initial investment cost. Due to the nature of this formula, it's a polynomial equation. IRR is typically not solved directly by hand with a simple algebraic rearrangement, unless it's a very simple 1 or 2 period case. It's usually calculated using financial calculators or spreadsheet software like Microsoft Excel, which has an IRR function, an iterative process, trial and error, where you try different discount rates until you find the one that makes the NPV very close to zero. Example of IRR calculation, conceptual iteration. Let's assume you are considering investing $10,000 in a small project and you forecast the following cash flows. End of year 1, $5,000. End of year 2, $4,000. End of year 3, $3,000. Since there's no direct algebraic way to solve for IRR easily, we'd conceptually use an iterative trial and error process. Let's start with a trial discount rate, say 10%. We'd calculate the NPV at 10%. NPV at 10% equals negative $10,000 plus $5,000 divided by 1.1 to the power of 1 plus $4,000 divided by 1.10 squared plus $3,000 divided by 1.10 cubed. NPV at 10% approximately $105. Since the NPV is positive, our trial discount rate of 10% is lower than the actual IRR. A lower discount rate makes future cash flows worth more in PV terms. To get NPV to zero, we need to try a higher discount rate. Let's try a higher rate, say 12%. NPV at 12% equals negative $10,000 plus $5,000 divided by 1.12 to the power of 1 plus $4,000 divided by 1.12 squared plus $3,000 divided by 1.12 cubed. Net present value at 12% approximately minus $10,000 plus $4,464 plus $3,188 plus $2,135. NPV at 12% approximately equals negative $212. Now the NPV is negative. This means our trial rate of 12% is higher than the actual IRR. Our iterative calculations show the IRR lies between 10% and 12%. While we could continue this trial and error process for greater accuracy, a precise calculation using Excel reveals the IRR to be 10.65%. NPV versus IRR. Regarding the NPV equals sum of CFT divided by 1 plus R to the power of T minus initial investment. In this formula, R, the discount rate, is an external variable that you set. It represents your required rate of return, your opportunity cost of capital, or your hurdle rate. You input R, and the result, NPV in dollars, tells you whether the investment is worthwhile relative to that specific required return R you entered. A positive NPV means it exceeds your required return. IRR, internal rate of return. Formula structure, 0 equals sum of CFT divided by 1 plus IRR to the power of T minus initial investment. IRR is the R that makes this equation true. IRR is the solution to the equation when NPV is set to 0. In this calculation, you do not input R as a given. The formula, or software, calculates the IRR that makes the NPV equal to 0. The result, IRR as a percentage, tells you the internal inherent rate of return of the investment itself, based purely on its own cash flows and timing. You then compare this IRR to your required return. Both NPV and IRR are powerful tools, and they often lead to the same investment decision. For example, if IRR greater than your required R, then NPV at that R will usually be positive. However, as noted, there can be situations like comparing mutually exclusive projects of different sizes, where they might give different rankings, and NPV is often preferred in those cases because it shows the absolute value created. This concludes our main topics on valuation metrics.